Hello everyone, today I'd like to discuss the differences between the 15-year mortgage and the 30-year mortgage. The real estate market can be very hard to predict, but it can be very helpful to look at history to see what might be a better option moving forward. So first, let's just look at the bare-bone financial aspect of the differences. Just for the sake of simplicity for this video, let's just say in both instances we're taking out a loan for $500,000. Another aspect of mortgage loans is that you have to pay interest over the term of the loan. So if you take out $500,000 for a 30-year period, you're not going to be paying back $500,000 in total. You would end up paying more because of interest. If you end up needing to take longer to pay off the loan, in general, you have to pay more in interest. So for the case of a $500,000 loan over the course of a 30-year period, with the current interest rate of 7.471%, the monthly payment calculates out to $3,486. And comparing that to a 15-year mortgage with the current interest rate of 6.476%, the monthly payment calculates out to $4,349. If we look at what we pay over the entire course of the loan, let's say the 30-year mortgage. If we take that monthly payment and multiply it by 12 months in a year, and we take that amount and multiply it by 30 for this 30-year mortgage, then you end up paying $1,254,960 in total, which means that you end up paying $754,960 just in interest, not even towards the equity of the home. And looking at what we pay over the term of the 15-year mortgage, we take the monthly amount, multiply it by 12, multiply it by 15, and we get a total amount of $782,820. In that case, you're only paying $282,820 in interest. From this analysis alone, it may be very obvious that the 15-year mortgage is obviously much better because you end up paying much less in interest. But the one thing this doesn't take into account is the appreciation in the value of the real estate. So after looking at many different websites, the average appreciation of real estate is very variable and is highly dependent on your local economy and local real estate market. But I want to run a couple simulations looking at a few different assumed averages, and we're going to look at a 2% assumed average appreciation per year, a 3%, and a 4%. Let's see how this pans out. So if you remember, we're assuming a $500,000 loan. I'm also just going to assume that the real estate is $500,000 at the origination point of the loan. So if we look at this chart, these are what the values would be given the assumed appreciation rate at the end of the loan term. One thing I find pretty interesting is if we just look at the 3% assumed appreciation rate in this simulation, it's actually very similar to what you actually end up paying over the course of the loan. But another factor to consider is that if these two simulations were to run at the same time, one, you start a 15-year loan, the other start a 30-year loan. When the 15-year loan is paid off, you have another 15 years for the property to appreciate or to continue to appreciate in value. And if we look at, let's just say, the 4% appreciation on the 30-year end, then the value of the property ends up being over double what you would have paid over the course of the 15-year loan. And that kind of wealth is much harder to attain with a 30-year loan. Okay, so another factor to consider is that although thus far the 15-year loan just seems like a much better financial decision compared to the 30-year mortgage, it is also less accessible because of its higher monthly payment. In fact, if you were to compare the 15-year mortgage yearly cost of paying off the mortgage, it's over $10,000 more per year compared to the 30-year mortgage. And a lot of people can't just pay another 10 grand plus per year. And another question that might be worth considering is it worth it to save up enough money or a larger down payment, let's say, so I can afford to do the 15-year mortgage rather than the 30-year mortgage? And the answer may be yes, depending on the situation. Let's say there's a situation where $3,486 is something that you can afford, but $4,349 a month is just a little bit too much to handle. Here are some questions I would consider if you're in that sort of situation. Is renting currently a cheaper option for you rather than compared to paying off a mortgage, like the monthly payment cost? Other question is, how long would it take to save up $100,000 in your current financial situation? What's interesting, and this may be just a coincidence of how I picked these numbers, but if you save up $100,000 and add that to your down payment, then the cost or the monthly cost of the 15-year mortgage actually comes down to where the 30-year monthly payment was. And so add $100,000 to the down payment and the monthly payment comes down to $3,486 a month. Now, to possibly flip this whole video over, and I don't really know what I'm talking about, but this is just a recent idea that I've had. It may be worth looking at your current savings rate, comparing it to what your savings rate would be when you owned a home, but also considering, would renting actually be a pretty good option for a long period of time? Or maybe even possibly, I don't want to say anything for sure, but never owning a home. I might make a video about that topic soon, about why I think renting actually is a pretty good financial option for a lot of people, but I'll save that for next time. I hope you enjoyed hearing some of the comparisons between the two different types of loans, and I hope you found this video a little bit informative. If you like this content and think you might like similar content, consider subscribing to the channel, and I hope to see you all in the next one.